Manufactured housing communities and why investors continue to flock to this high performing asset class. In manufactured housing communities, abbreviated MHCs, are often called mobile home parks and have quietly become one of the most sought after commercial real estate investments in America. While office buildings and retail centers have experienced volatility, manufactured housing communities have consistently demonstrated strong occupancy, reliable cash flow, and a recession resistant performance. And as a commercial mortgage broker with CommLoan, I regularly help investors secure financing for manufactured housing communities across the country. So, understanding how lenders evaluate these properties can dramatically improve your financing options and your overall investment returns. So, why manufactured housing communities continue to perform? Well, manufactured housing addresses one of the biggest, America's biggest challenges right now, and that's affordable housing. And as housing costs continue to rise, more families are turning to manufactured homes as an affordable alternative to traditional single family housing. And this growing demand has created exceptionally stable occupancy levels for well managed communities. And many manufactured housing communities operate with occupancy rates that exceed 90%, which provides their owners with predictable rental income and long term stability. So, why lenders like manufactured housing? Well, commercial lenders generally view stabilized manufactured housing communities as an attractive asset because they typically offer consistent and stable monthly cash flow with lower tenant turnover than apartments, but also strong occupancy history. And it's affordable housing on demand with multiple revenue streams and a proven operating history. And when a community has demonstrated healthy financial performance, lenders often compete aggressively for financing that opportunity. So let's talk about what lenders evaluate and how to position yourself for success. And every lender is going to have different underwriting guidelines, but most focus on several key factors. And the first is occupancy. And most lenders prefer stabilized communities with an occupancy rate above 85 to 90% on a consistent basis. Net operating income, or NOI, and cash flow remains the single biggest driver of value as well as financing. Infrastructure. So lenders do evaluate the roads and the utilities and the water systems and the sewer systems and the electrical infrastructure and any deferred maintenance that they can see from the appraisal. And communities requiring major infrastructure improvements may require bridge financing before they can qualify for permanent debt. So let's talk about tenant-owned versus park-owned homes. And many lenders favor communities with a higher percentage of tenant-owned homes because operating expenses and maintenance responsibilities are generally lower that way. Market conditions. So lenders also consider population growth and employment trends and local housing demand, but also comparable manufactured housing communities that are nearby and supply constraints. And growing markets with limited affordable housing are often going to receive the more favorable financing terms. So let's talk about some financing options that are available for mobile home parks and manufactured housing communities. And depending on the property and borrower, financing options can include conventional commercial loans, but also agency financing and credit unions and regional banks and life insurance companies, but also CMBS lenders and bridge loans and portfolio lenders. And choosing the right lender can significantly impact the interest rate and the loan term and the amortization and the recourse requirements and the closing timeline. So why working with a commercial mortgage broker matters? Well, not every lender is going to finance manufactured housing communities. And some lenders specialize exclusively in multifamily, where others will avoid manufactured housing entirely. Still others focus only on communities above a certain size or loan amount. And a commercial mortgage broker will help you match your property with lenders that are actively seeking manufactured housing loans. And at CommLoan, our nationwide marketplace provides access to hundreds of commercial lenders, helping borrowers identify financing solutions that fit both the property as well as the investment strategy. So let's talk about some common challenges. While manufactured housing communities are attractive investments, financing can become more complex when occupancy is below what lenders would consider stabilized, or if there's infrastructure that requires significant repair, or if there's significant park-owned inventory available, or financial statements are incomplete, or utility systems need upgrades, or ownership changes have recently occurred. And these situations don't necessarily prevent financing. They simply require matching the opportunity with the appropriate lender who has experience in transitional assets. So, final thoughts. Manufactured housing communities continue to outperform many commercial property sectors because they provide something that every market needs, and that's affordable housing. So, whether you're acquiring your first manufactured housing community or refinancing an existing portfolio, understanding how lenders evaluate these properties can help you secure better financing terms and close with greater confidence. And if you're considering purchasing or refinancing a manufactured housing community, working with a commercial mortgage broker like myself can help you identify lenders that understand the asset class and can compete for your business. Thank you for watching. You can visit my website, billrapp.comloan.com. You can start a pricing quote as well as to schedule a consultation so we could have a chat. I appreciate your time. Have a good day.